economists keep saying, oh, inflation is a rate of change. So if you have this one-off thing and there's no more knock-on effects, then there's no inflation. It's done. But that's not what the consumer cares about. They don't care about whether the rate of change is done or not. They care that their prices went up and they're not going down.
How long will this process take, by the way?
Years.
Lobo Tiggre of the Independent Speculator joins us once more. He will be talking to us about his outlook on monetary policy, global economic growth, and the resource sector. Which are the commodities that Lobo likes the best? What will the Fed do next? What's going to happen to gold after it's been plateauing for quite some time? Is it too late to get in gold? Should gold investors take profits? These are all questions we'll be addressing with Lobo today. So very exciting episode up ahead. I'll be attending the Precious Metals Summit in Beaver Creek, Colorado in a few weeks, September 9th to 12th to be exact. And I'll be covering the conference by interviewing some of the most prominent thought leaders in the resource sector. They have a great lineup of keynote speakers this year, as they always do in prior years. I'll also be interviewing key CEOs of the resource sector, bringing you insights from the ground that you've never seen before. And I'll be airing these episodes shortly after the conference, so stay tuned. It'll be sponsored and brought to you by Tudor Gold. Back to Lobo. Thanks for being here, Lobo. Good to see you as always.
Always glad to be on the show with you, David.
What's going on in the world, Lobo? We caught up a couple of months ago. What do you think has transpired globally that has caught your eye? How do you see the planet of humans evolving over the next couple of months? I'll leave it very broad for the first question.
Sure. There's a lot we could say there, but I think there is one important central theme. This is not entirely new, but maybe it's more important, more urgent than ever. And this isn't just a Loboism, but complacency. Complacency on Wall Street. And I'm not just talking about new all-time highs every week in the S&P 500, though that's part of it. But just there's a growing drumbeat in the narrative that the worst of Trump shock is behind us. You know, ever since so-called Liberation Day, it's been that was the worst and that's behind us. Everything's getting better. And I just don't think that's true. Maybe the most shocking announcements are behind us, but as we see right now, we've got Trump just smacking India with a 50% tariff because they're buying Russian oil. I don't see them stopping to buy Russian oil. I think it's optimistic to think that suddenly peace will break out. I'm not sure how that one plays out, but it's just one example of how, the shocks are not done coming. But that aside, let's say that Trump's done. No more new tariffs. It is what it is. The deals are what they are. The letters have gone out, right? It's done. No more shocking new announcements. Well, fine. That's the deals. That's the announcements. That's the letters. What about the impact of these things on the real economy? That is still in front of us. And so I come back to my initial point. I really think that it is a mistake, and it's surprising to me that such experienced investors on Wall Street, people with giant buildings full of supercomputers, are making what looked to me to be like such a rookie mistake. The piper has not been paid for what's being done right now, let alone anything else. And that has consequences. And I do expect to see the boat rocked. I'm not saying the market's about to crash or anything dramatic, though that could happen. Mm-hmm. I'm just saying Trump shock ain't done yet. It's got to work its way through the real economy, and that will impact our investments and investors abroad and in general.
Well, as we speak today on Wednesday, Trump just slapped a 50% tariff over India on the news that they bought Russian oil. Steep U.S. tariffs on a range of Indian products have taken effect, threatening a serious blow to India's overseas trade in its largest export market. This is one of the highest tariffs imposed on any country to date. Markets actually are kind of unmoved today on the news. Crude oil is up 1%. That's the big mover. Treasury yields are slightly up. Now, I just to illustrate your point, so tariffs aren't over. What are these consequences you're talking about, Lobo? You're not calling for a market crash right now, but what are these consequences of Trump's quote-unquote rookie mistake? What do they look like?
No, I didn't say Trump made the rookie mistake. And whether or not you agree with Trump's agenda or not is a whole separate kettle of fish. I think Trump has an agenda, and I think what he's doing is consistent with that agenda. And again, whether you agree with it or not, I actually don't think Trump is being stupid or crazy in terms of him pursuing his agenda. Now, whether
Sure.
you agree with each other, that's a separate question. I was saying the Wall Street guys, the fat cats with the big investment firms,
Okay.
they're the ones who are drinking the Kool-Aid and thinking, oh, everything's fine, nothing to worry about here, move along. These aren't the droids you're looking for, right? Um, so as far as the consequences, even the mainstream, like you listen to the debate about tariff inflation and so on, the debate is not about whether or not prices are going to go up. Like even though Trump keeps saying the Chinese are going to pay the tariffs or whoever, the foreigners are going to pay the tariffs, I think pretty much everybody besides Trump is acknowledging that U.S. consumers are going to pay at least some higher price as a result. The argument isn't about whether that's going to happen or not. Like left wing, right wing, red, blue, doesn't matter. Everybody sees this coming. What the debate is about is whether it's going to be, they don't want to use the word, but transitory, right? It's one off. You have these higher tariffs, so there's a one off adjustment, and then there's no more inflation because it's been paid for. That's one argument. And other people say, well, no, that doesn't take into account the knock on effects, retaliations, or, one of the big factors right now is all the not just companies that front ran the tariffs and ordered a bunch of things from abroad before the tariffs went in, but the consumers who stocked up on things before the tariffs went into effect. So as that cushion, that safety margin gets consumed, then you start seeing more of the tariffs impact both the consumer and the producers in terms of their stocks. So I think it's a mistake to just dismiss the tariffs and say, oh, there's no, inflation's only 3%. That's fine. The impact of what's been done and what's being done right now is still to work its way through the real economy. That's point number one. Two, there are the knock-on effects. So there could be more price inflation. It may not be a one-off thing. And then three, the big one is that economists keep saying, oh, inflation is a rate of change. So if you have this one-off thing and there's no more knock-on effects, then there's no inflation. It's done. But that's not what the consumer cares about. They don't care about whether the rate of change is done or not. They care that their prices went up and they're not going down. So to ignore the inflation impact of the tariffs by saying it's one and done and we don't have to worry about it anymore, that ignores the fact that prices are going to go up significantly, as much as 50% for some products, perhaps. And the consumers are not going to be happy about that. And by the way, they vote. So I do see this as disruptive. Even if it did turn out to be transitory, it is significant now, this year, and this is at a time where the labor market is showing weakness. So you got weakness in the economy and you got higher prices in the economy. That's stagflation. And we all know what stagflation did for assets last time around in the 1970s.
Assets being gold, silver, real estate, hard assets, commodities. Is that what you're referring to?
Yes. Well, I mean, you're naming the ones that did better. Like real assets did better, including real money, gold and silver. Other assets, not so much.
You're not the first person to tell me this week, by the way. I'm not talking about this whole year. This week that we're entering stagflation. What's the Fed going to do about this?
Well, two things. One is we had a former Fed president interviewed at Jackson Hole saying, gee, I'm not saying it's going to be like the 1970s, but it sure looks like stagflation. And to have a Fed or former Fed official actually use the dreaded S word is really quite striking. So this isn't just tinfoil hat Lobo off in the forests of Lithuania talking about something crazy that'll never happen. A former Fed president is saying the economy right now looks like stagflation. And then the other, the answer to your question is, what's the Fed going to do about it? If you remember when that reporter was probably never invited back to a press conference by Powell, but a reporter asked Powell, what is he going to do if there's stagflation? What's your plan for dealing with stagflation? And Powell's plan was to not let it happen. Well, guess what? It's happening. So where does that lead? You have no plan. And this makes sense, David. The toolbox of the Fed, they talk about all these tools they have. There's really one. I mean, one and a half maybe. They muck about with interest rates. And yes, QE fiddles around on the side. But if your tools are to throttle the economy to bring inflation down because the economy is too hot, that doesn't work when the economy is already weak and the labor market is weakening. And if your tool is on the other hand, is to stimulate the economy to get it going because the labor market's weak, that doesn't work if inflation is already high because your stimulation is going to make it higher. So the Fed's tools are completely inadequate to a stagflationary environment. They're damned if they do and they're damned if they don't. So what do? I can't tell you what they will do. I'm guessing that they will probably err on the side of throwing the dollar under the bus. That meaning loosen, make easy money easier to support the labor market. Partly because the pain when it sets in will just be really, really hard to ignore. And partly because the United States administration is firing Fed officials and bringing serious pressure to bear on the Fed. So I'm skeptical of how resistant the Fed will be to pressure going forward. It seems that Powell's speech at Jackson Hole has already suggested that the Fed is feeling the heat.
I want to get you to react to something Ray Dalio posted about. Well, I won't ruin the surprise in just a minute. I think you'll have an interesting reaction to this. But just on the stagflation front, Lobo, didn't we already have stagflation in 2022 when inflation was just coming off the heels of 9.1% in the U.S. and we had 2 quarters of negative GDP? I mean, that was a short-lived stagflation. People say we haven't had it since 1970s. Well, we saw that what happened to markets. Markets came
Right.
down and then we recovered. So
Yeah.
could one make the argument? I mean, that's already come and gone. And
You could, but that would be like a textbook argument.
right.
And this is part of my whole thing. And even Trump's administration has talked about Main Street versus Wall Street. It's Main Street's turn, right? On Main Street, a technical definition of a recession or a technical definition of a stagflation, that doesn't matter. What matters is, what am I experiencing? And if I'm experiencing high prices, and again, it's high prices, not increasing. Like, the increasing is worse. But if they're just high, I'm unhappy. I don't care if the rate has gone down. I care that the prices are high. I care that my grocery bill is much higher than it was last year. And the fact that it's not still going up quite as fast doesn't matter. It's still higher and going higher. So you have that at the same time that now, where before I wasn't worried about my job, but now I am, then I'm not happy. And so, I'm not too concerned about technical definitions. And as you know very well, the
Sure.
NBER, they're not going to declare a recession until a year or two after the fact. So I think those kind of, technocratic ways of looking at it are not very useful. It's more useful to consider, what's the reality on the ground? How are people going to react? What behaviors will change? How will employers change their behavior? How will employees change their behavior? And what does that do in my investable time frame?
What would this stagflation this time in 2025 or 2026 and beyond look like compared to the 70s? The 70s were spurred partly by an oil shock. That's not what's happening today. So I'm wondering how the end result may compare.
Yeah, I think that's a really good point. And, I would agree with Harker, who said, it's not going to be the 1970s over again. But even if it doesn't repeat and it just rhymes, I think that's still, if nothing else, very bullish for gold and silver. Because, again, what did really well in the last time around? If that's your only comparable, even if it's not a very good comparable, that's still the only comparable. And I think that adds to the tailwinds for gold and silver. And the beauty of it is, if they're already at $3,500 and $40, or close to that, and you're looking at upside pressure, that's very, very bullish. To answer the question, of course, I don't have a silver ball. Yes, many things are very different. The OPEC oil shock isn't happening at the moment. On the other hand, it seems like things have calmed down in the Middle East, with Israel just deciding to pound another piece of the Gaza Strip into dust as opposed to bombing Iran. It's certainly less concerning from a global geopolitical perspective, but it could heat up again. So that whole oil thing could come back into play and make it rhyme more. But never mind, it doesn't have to happen. I have a feeling that actually, without anything new happening or change in the geopolitical scale, I think it will not be that much like the 70s. I think this time, the powers that be, whatever the Fed does, by the way, remember, there's not just monetary policy, there's fiscal policy. And I think Congress has no patience for suffering voters out there. So I think the money helicopters will just get, sent into overdrive. What I'm saying is, the stag part, if it really starts to hurt, I don't think we're going to get anywhere near the protracted stagflationary bout that we had in the 1970s. I think as soon as the stag part is clear, the Fed is likely to jump in to help. And whether they do or they don't, I anticipate Congress will jump in to help and the money helicopters will fly. And so we get a reflationary boom. I don't know the future, but you're asking me for my best guess. My best guess is that the stag part will be fleeting and we probably go quickly into a more reflationary boom. And maybe then the Fed says, oh, we need to fight inflation again, but by then it's too late. By then, Powell's hopes of being remembered as a Volcker are out the window, and he's going to be remembered as another Arthur Burns.
You know what else happened in the early 70s? The gold standard was removed, and now we have Ray Dalio, one of the thought leaders in the finance space, CIO of Bridgewater, or former CIO. I think he's now no longer directly involved. But anyway, he tweeted this: the US dollar used to be backed by gold, and it's not far-fetched to think we may be headed there again in the future. History shows us that the same cycles repeat time and time again. One such cycle is related to currency devaluation. Once people start to lose trust in the system, we see specific cause and effect. Governments print a lot of money. They paid off the debt with the cheap money. Nobody wants to hold the devalued currency. Governments go back and link money to gold. Will this pattern happen again? It's hard to say, and it wouldn't happen anytime soon, but it is conceivable. Okay, it wouldn't happen anytime soon, but a return to the gold standard is conceivable. Do you agree?
Absolutely, yes. The short version of what Ray just said, which I agree with, is that Gresham's law goes both ways. And, when crisis comes and the confidence is lost, even the Roman Empire, they'd have to go back to finding a way to produce real silver coins again that weren't full of copper, right? Or ultimately just like copper instead of silver. Reality does matter in the end. But actually, I want to rewind the conversation a little bit, combining our previous point in this one. I think This is really interesting. This is one of the differences. The fact that the U.S. abandoned the gold standard or the rest of the gold standard in 1971, when actually, in August, we're on the anniversary here. 54 years ago, Tricky Dick Nixon took the U.S. off the remnants of the gold standard, slamming the gold window on Charles de Gaulle's fingers. That had a coiled spring effect. The U.S. had already, under Johnson, guns and butter, had been spending way beyond its means. And this is why it happened. People didn't believe that the value of the dollar was what the stated relationship with gold was. So gold soars when it's freed from the dollar. And that coiled spring effect, that's one of the differences between then and now. Like you asked about how will it be similar or different from the 1970s? This is one of those things that's different. Now, some people, a lot of, diehard gold bugs will say, well, the gold and silver price has been manipulated for so long. It's been artificially suppressed. So they might actually argue that this is a similarity, not a difference. I don't know what the truth of the matter is. I don't know how manipulated the price of gold was. But I just think this is kind of interesting because on the face of it, this is a big difference. There is no official peg, or hasn't been one for 54 years, between the dollar and gold. But if the people who have been arguing for the suppression of the price of gold, if they were right and suddenly that's over and gold goes shooting up to 3,500, who knows how much higher it'll go. That might actually be another tailwind for gold here. I want to be very careful. I'm not saying this is true. I'm not saying suddenly I subscribe to all the conspiracy theories. But I'm also not saying that they've been proven wrong. I just think there's an interesting parallel here. As far as Dalio goes, I think the way that happens, and it may happen sooner than he thinks. He's a student of history, and he knows that history takes all this time, hundreds of years. The fall of Rome was like 300 years long. But now things happen faster. And I think the vector here is I actually find some credibility to the idea that the BRICS might introduce a gold-backed currency of some form. And, blockchain makes that easier. And well, why would they back it with gold? Why not Bitcoin or why not nothing? Just make a BRIC currency. And I think the reason for that is, no offense to the Bitcoin crowd, gold is real. You can hold it in your hand. You can see if you're China and Russia says, we're contributing this many tons of gold, and China's saying we're contributing this many tons of gold, and India says we're contributing this many tons of gold. You can send somebody to go look at the vault and see if it's actually there. and there's not a whole lot of love to be lost between the Chinese and the Russians, for example. So between these very different countries with very different cultures, I think that it actually makes sense to use something physical, visible, measurable, tangible to back such a currency because it enables trust and verification that nothing else does. So who knows? I'm not saying this will happen tomorrow. I think something like that, even with a crypto system for delivering it worldwide outside of the SWIFT system, makes sense. That's not the sort of thing that you can just launch overnight. So I think we'll see it coming. We'll have plenty of warning. I think that will be an investable trend when it starts happening. It's not happening today, but I could see it happening. And then if it does, I can imagine everybody else following suit. And it
Let
will
me
be
just
really.
add,
Go ahead.
sorry.
Go ahead.
Oh, I was going to add to that and maybe get you to respond to my theory here. In 1944, more than 40 allied nations met in Bretton Woods, New Hampshire, hence the name Bretton Woods, and they decided to start a new monetary system. And that lasted until 1971, as you know. Now, what could happen this time around if we were to revisit this idea? Perhaps we would have two axes here, one from the BRICS and one from the West and NATO members. I don't see a global cooperation between, let's say, China and the U.S. deciding on a joint, common, global, gold-backed standard currency. I don't, we've got too many different ideologies going on right now. So that may be an impediment to returning to the global.
But that's the beauty of it, David. That's exactly why I'm saying that this may well involve like actual physical gold backing, because that makes it possible for very different cultures, languages, ways of thinking about business and money and everything. It is that very thing that Bitcoin people like to mock, that physical weight. Remember that drop gold campaign, those poor people in their business suits carrying these heavy bags of gold? Like that very thing is what makes gold a useful intermediary in this environment. And if you think about it, like this isn't some strange new invention. This is actually the way the world worked before. You think the French and the British loved each other in the 1700s? Of course not. Or the Spanish and the British, a couple hundred years earlier? Of course not. And so are you going to trust each other's pieces of paper or even coinage but like the metal inside had value that was objectively measurable. And that allowed international commerce to happen even amongst enemies, like actual warring enemies. So I think it actually makes sense that if the fiat system as we know it breaks down and there's no confidence on any side and the parties don't trust each other, it makes perfect sense to me that something physical, measurable, verifiable would step in to help smooth things over. And that's why it was done before. International trade was not settled in dollars or francs or rubles. It was settled in gold.
I want to point something out to you. We're talking about gold. This is the gold to oil ratio. Gold to oil, historical chart. Now, every time it's spiked in the past, we've had a recession. 2020, something dramatic happened, as we know. COVID, global economy shut down. Oil tanked, gold spiked, gold to oil ratio shot through the moon. 2008 happened again. 2000, it happened. On and on and on. You see the pattern. I mean, there's been exceptions, of course, but now we're seeing gold and oil, the gold oil ratio, once again rally. And this is sounding some alarm bells with some analysts who follow this trend. What's your take on this?
I think it's a very good thing to point out. And it's maybe not as simple as one might think, but just on the face of it, what does this ratio tell us? If gold is up, that means safe haven demand is up, fear is up. And if oil is down, therefore the ratio goes up, then that means economic energy is down. The economy is looking weaker, weakening demand on the economic front. That's recession. So there are people, Peter Schiff, my fellow Puerto Rican among them, who argue that the U.S. is already in a recession. I think Danielle DiMartino Booth said it recently too. I don't know if you've interviewed her recently, but there are people out there saying the U.S. is in the recession. It just hasn't been recognized yet. And this chart would back that up. The the pushback on that, or maybe to steelman the other side, as Lex Friedman might say, is that we are entering a different world. I mean, I guess the other side would be Doomberg. You've interviewed him, right? And
Yes.
he's talked about how, it's oil equivalents these days. And it's not just LNG, but it's all kinds of things that are convertible. And so you can't just look at oil by itself. And he doesn't believe in peak oil at all. And he sees all these oil equivalents coming to market in increasing ways. So it could be that we're looking at like the past range of the gold or oil ratio. That may change forever. It may never go back to its historic range if Doomberg is right. And that would be completely different from whether or not there's a recession now. So like this spike that you're seeing on your chart right now, and really since 2008, the upwards, roughly speaking, upward trend in that ratio, that could be indicating what Doomberg is saying rather than anything about the economy overall.
What is the investment thesis for gold now that it's been trading range bound around $3,200 to $3,400 for quite some time now? By quite some time, I mean a few months. Somebody says to you, Lobo, I missed the boat on gold, and now it's just kind of hovering in a range. I don't know what to do.
Somebody just asked me this at dinner, and I told him normally, before this year, if gold went up, screaming up like it did to 3,500, I'd be the guy getting rotten tomatoes thrown at me at the Vancouver conference or whatever for saying, when something goes vertical, it's time to look for some correction. It's time to take some profits here. And, this is not the time to chase anything, and remember that $3,500 high, that's not just a nominal high. That's actually a high adjusted for CPI. So that is a material thing. Yeah, that is a striking chart. And normally when a market goes screaming up like that, you want to be thinking more in terms of taking profits than buying. But in this case, again, sort of like with the Doomberg thing in the oil, I think we are looking at a changed game. The central banks buying since the weaponization of the dollar, that is a one-way door, David. The Chinese and the Indians, are certainly not the Russians, they're not going to go back to trusting the United States dollar the way they did before the Russians were kicked out of the SWIFT system. That's just not going to happen. And we see this. There's been times aplenty this year when news that normally, or not normally, but like in the recent past would have been headwinds for gold, gold wiggles a little bit and then comes right back up again. And to me, this is evidence of the central bank gold buying. And the World Gold Council charts show that the central bank gold buying continues at a higher pace since 22, since the weaponization of the dollar. So what I'm saying is my normal caution about something that pulls a hockey stick like gold did recently is ameliorated by this game-changing scenario where you have not just a new buyer here, but like a global set of new buyers who have very, very deep pockets. And I really do think this is a one-way door. I don't think the governments and central banks around the world that are now hedging their exposure to the dollar are going to suddenly decide, oh, it's okay, we'll go back to how things were before. It's the Chinese and the Russians certainly aren't going to do it. So the answer to the question is this. I'm even uncomfortable saying it, David, because it is so ingrained in me that when you see something go up, it's time to think about taking profits. But somebody doesn't, they missed it. They don't have any gold. They haven't bought any gold stocks. I am right now. My guidance is yes, I would buy at these levels because I think we have a floor here. I see relatively little downside. And you asked, what's the argument? The argument is everything that's happening under Trump in the United States, everything that's happening in Europe with the remilitarization and the deglobalization, the Chinese response, the Russian war machine, all of this stuff is inflationary. That is bullish for monetary metals, including gold and silver. So there's this big, massive macro argument that is bullish for gold at a time where central bank gold buying has put something of a floor at a high level under there. That's what makes me comfortable saying, yes, even over 3,400, if I didn't own any gold, I would buy some today, and I would certainly look for the better gold stocks.
And if, just another point supporting your argument, if the entire gold market wanted to take profits, which they could have done since April, right? They had 3.5 months to take profits. They would have. And there was some profit taking along the way when they reached the gold price reached new local highs. But overall, like you said, there was a floor established. The market did not tank. The market did not take huge profits like in 2011, right? This didn't
Yeah.
happen.
Yep.
And we saw that in 2020 as well. That didn't happen this time. What
Yep.
happened was just a stabilization of the price around new to all-time highs.
Yep. Yep.
So,
And here's one more thing to think about, David. Uh, you know, if gold dropped $1,000 an ounce from where it is today,
well, that's an
that'd take us
interesting
down
thought
to,
exercise. Okay.
I mean, $1,000, like, wow, that's huge. $1,000 drop. I mean, it's not going to happen, I
Yeah.
don't think. Or certainly not all at once. But if it dropped $1,000 an ounce, that would take us down to 2,400. The mines that are in operation, the gold mines that are in operation today, they were built based on feasibility studies at like 1,700, 1,800. The better ones, 1,300, 1,400. So gold could drop $1,000 an ounce, and you'd still be looking at uh, not obviously not as fat margins as we have today, but you would be looking at decent margins for all but the crappiest of the gold miners out there. So you talk about a moat, and if you want to be a cautious Warren Buffett style person, okay, metals stocks, mining stocks are not going to be a Warren Buffett thing in large, but think about that business. It could drop $1,000 an ounce and you'd still be making money. So if there is a correction, my takeaway here is that if there is a correction, I think that would be a gift from the market, a buying opportunity to take advantage of.
Are you this bullish on all the precious metals?
Well,
Somebody says to you, I missed
the
bull run on silver.
Right. So I don't
yeah.
count.
What would you say?
Count platinum and palladium and those other expensive silvery industrial metals as monetary metals. I don't like the term precious. It's either monetary or it's industrial. That's the way I look at these things.
Okay.
So the answer to the question is yes and no. And silver bulls hate me when I say this, but silver's relationship with gold has visibly changed recently as well. Now, it still acts as a monetary metal. There's days when, say, copper and other industrial metals go down, but silver goes up with gold. So yes, silver's still a monetary metal, and silver has not reached all-time highs. So that I think that volatility aside, that makes me confident actually in more upside in silver than gold. Let me repeat that. I see more upside in silver than gold right now. Now, that doesn't mean it's going to go straight up. That's the catch. The industrial side of silver can be a tailwind or a headwind. And if I'm right about, Trump shock working its way through the real economy in the months ahead, well, that's going to have an impact on industrial demand for silver. So there could be a headwind in the near term for silver. If that happened, I'd probably just buy more. In longer term, I'm very, very bullish. So all you silver bulls, put away your rotten tomatoes. I'm not making a bear case for silver. I'm just saying, you ignore its industrial side in the near term at your own peril.
What happened in June? Early June, there was a huge run up of silver price.
Yeah.
Of the silver.
So
price.
I don't know if you can do it on your chart there, David, but that happened at the same time that platinum and palladium and even rhodium were moving. And interestingly enough, gold was not moving at this time. So there are a lot of people that got all excited when silver went shooting up to $40 and they're saying, this is it. The de-dollarization trend is finally hitting silver and it's off to the races now. But it didn't. If it was de-dollarization or if it was something monetary that made that happen, gold would have moved at the same time, but it didn't. It moved with other
with silver
industrial metals. So I don't fully understand what happened there, to be honest with you, David. But to me, it's just very striking that when this happened, it was a bunch of industrial minerals that moved at once and not the other monetary metal gold. So I'm not making a bear case. I don't hate silver. I think the industrial side of silver actually it puts a bigger tailwind in silver sales on the other side of Trump shock because it has all this extra demand as an industrial mineral that gold doesn't have. So I really like silver. I'm just not willing to ignore the reality of data such as you have on the screen right now.
Platinum went up early June, like you said. I'm trying to understand. I know we don't have an exact answer for this. I'm just trying to understand the impetus behind these moves, which are very much correlated now that I have them both on the same chart. Lobo, I'm trying to understand. Maybe there was some tariff announcement that proceeded, which sparked a huge demand for platinum hoarding or industrial metal hoarding. I don't know. I'm just speculating here. It's important to understand maybe what happened so that if the same event happens again, we could be ready.
I agree. And it would be great if we could do that. But the honest answer, David, is that I don't know. I've heard many theories. There were a lot of people at the time this happened saying, oh, it's because gold got expensive and the Chinese started buying silver instead. Well, but that doesn't explain platinum moving at the same time. And there were other people saying, oh, well, it's the automotive industry coming back and platinum and palladium and rhodium are all up. Well, but silver is used mostly in solar panels. There is some in the cars, but not in catalytic converters. So it doesn't make sense for it to move on that basis either. So I've heard various explanations. The Russians are buying silver now. There's a bunch of things out there, but I didn't find any of them very satisfactory. It might just be like just global positioning, the tariffs, as you say, or China stockpiling like everything industrial. That would explain a multi-asset move like this. And we'll never know, except for possibly in hindsight, somebody comes out and discloses it. So, I wish I could tell you, here's the trigger, watch for this in the future, and that'll tell us, when to bet on this move happening again. But I don't think anybody knows that. The only takeaway I can say is that in this moment, silver acted more like these other metals than gold. And so be cautious about assuming that silver has to act like gold all the time.
I've added copper and palladium to this chart. I know it's a bit messy now, but here, let me just remove palladium. It's not really necessary.
Actually, no, I would take copper off because that's very different. That huge move on
we'll talk about copper.
Huge move on copper was because of a tariff announcement and then an unannouncement, right?
Yeah, the point I was trying to make was that barring those tariff announcements and the announcement, the prices moved kind of in lockstep up until that announcement. But yes, let's put palladium back up. Palladium has been actually selling off, unlike platinum and silver. Again, is there a story there?
Right. Again, they are all industrial metals, but in different markets. So that's why, I don't think it's just like the auto industry. It might be China, stocking up or not, or, whatever. And again, not to repeat myself, I do not know the answer, David. I don't want to tell your audience, do this, bet on this. Next time, here's the trigger. I don't know. But be careful about what you assume on this basis.
Well, let's just talk about copper now. Is this an arbitrage opportunity at some point with copper? This is the U.S. market, right? This is COMEX, and so there was some discrepancy between pricing on the COMEX and the LME, which contributed to I'm being I guess politically correct, but there's some arbitrage happening here. That's what partly contributed to this big downdraft in the price. This here, like you mentioned, was the tariff announcement, 50% copper tariff announcement. And I don't know.
The big one on the downside was the announcement that, like the actual copper product that is traded, what we trade on the COMEX, was going to be excluded from the tariffs. The tariffs are on finished products and things.
So 449, that's the fair value now. That's the fair value of copper. It's been trading that way since a couple weeks now.
The issue there is that, again, as we started this conversation on the macro, I do think that there's more Trump shock to hit the economy, and Dr. Copper is called that for a reason. So if I'm right about more weakness in the economy ahead, and not just in the U.S., by the way, then I think there's near-term vulnerability to copper. Now, if I could sit that out, like if I'm a long-term investor and I don't care if copper goes down 30% from here, because I'm confident it'll go up in the years ahead, and if copper goes down 30%, the copper stocks will go down 60% or, something like that, right? So, if I've got a 10-year outlook or something, maybe I just go ahead and buy this dip and don't worry about it. But in my experience, most investors don't have that kind of staying power. They don't like it if they buy something and it goes down 60%, no matter how much they believe in it. So if you're not willing to take that risk, I don't think copper just goes to the moon and never looks back tomorrow. I think there's time to wait and see if the other shoe drops and if copper gives us a shot at lower prices. Basically, this is what I'm doing with my own money right now, David. I'm extremely bullish on copper going forward. Even longer term, even more bullish than uranium. But I see such potential for near-term correction in copper that I'm still mostly accumulating cash. I did buy one stock that got oversold, but mostly I'm just accumulating cash and waiting to deploy. So I don't know the future. I can't promise what will happen or if that's a good idea or not, but I can tell you that's what I'm doing with my own money.
Which of these commodities do you like the most? And we haven't talked about uranium yet. I wonder if uranium is the answer to my question. If not, what else?
Yes and yes. Copper was my top pick for this year. And the reasons for that are mostly still ahead of us. I'm still very, very bullish on copper, except for this near-term thing. But I got to say, at this particular moment that we're talking, uranium, it visibly carved out a bottom a couple months ago, and then it kind of got ahead of itself, and then it fell back again, and it now looks to be carving out a bottom again, and that puts it on an upward trend. So if I miss the last big uranium move upwards, I would not dally right now. And right now, as much as I like copper, like going forward and for years to come, I see more opportunity right now in the uranium space. So if you ask me what is my top shopping priority, it is absolutely no question uranium. More than gold, more than silver, more than copper. Right now, if I could only add, I had a choice of all, and I only could add one, it would be uranium.
Get your reaction to this article from the Energy Department. Energy.gov is a website. 9 key takeaways from the president's executive orders on nuclear energy. I won't read all of them, but let's just go through some of the highlights. Speed up nuclear reactor licensing. Add 300 gigawatts of new U.S. nuclear capacity by 2050. Well, that's still some time away, but
But it's
that's a
huge.
plan.
And by the way, the Chinese are doing more than that by 2040,
Hmm.
which is, on the scale of time it takes to build nuclear power plants, that's like tomorrow.
Well, what does this mean for investors, though? I mean, I know for a fact that a lot of the uranium that the U.S. nuclear reactors use does not actually come from the U.S. And in fact, uranium production in the U.S. lags behind other countries. So
But
should
it
we be
dropped to
looking
almost
abroad?
zero until recently. So there's
Exactly.
no question about that. So no,
Should
it's
investors be looking abroad? Should investors be positioning
both.
now to
Both.
U.S. companies
Uranium
in
is valuable
anticipation?
enough to be a globally fungible commodity.
Hmm.
So this is very bullish for the uranium market around the world, but it's also obviously bullish for U.S. sourced uranium. There's a clear bias and preference here. Like this is explicit. So you know who they are. I don't give free stock picks, but it's pretty clear who actually has uranium production in the United States. I'm not saying they're all good picks, by the way. Some of them are really struggling. Some of them are doing better. Um, but I think it doesn't take much due diligence to tell who's going to be able to deliver U.S. sourced uranium to the market, and they will have an extra price advantage. That is a material and investable fact. But
Well, I think
again,
it sounds like Trump. Sorry, go ahead.
no. Well, okay. So I was going to say, don't underestimate the global aspect of this. When I say the Chinese are building even more reactors and doing it faster, that really matters. This is such a powerful global trend that even Sweden, this announcement was just today, and Sweden is like Germany, like one of these most anti-nuclear in a way places, and particularly the mining. And I just saw an announcement today that Sweden is now looking at permitting uranium mining. And this is as big a deal as Germany saying, well, maybe we should reconsider nuclear power. In terms of straws in the wind, sign of the times, whatever you want to call it, this is huge. I mean, this is like the United States is talking about reactivating 3 Mile Island. Like that is jaw dropping that would even be considered, given the fear around that name. So what we're saying here, David, the key takeaway is that the demand side of this story just keeps getting better and better on an almost daily basis. I mean, it's unbelievable how much we're seeing the demand side increase here. And at the same time, we're seeing the supply side still constrained. There was a reasonable fear that the low-hanging fruit of like mothballed mines that could be brought back online or low-cost projects that could be built to bring new supply online, it was reasonable to worry about, that possibly oversupplying the market in the near term. But now that it's started and these mines are being built or refurbished,
Yeah.
they're almost all behind schedule or over budget. Some of them aren't happening at all. So while it was reasonable to worry about high prices curing high prices in this market, it is no longer reasonable to me. The market has shown that it's easier said than done to bring these uranium mines online. And so demand's going up, supply remains constrained. This is clearly bullish. And sorry, one final thing, uranium
Yes.
prices are highly recession resistant. So while I'm worried about copper and maybe even silver a little bit in the near term because of
Mm.
economic weakness, I think that has zero impact on uranium.
You don't think electricity consumption will change given a recession?
It will, but not baseload power. When you use uranium because it's 24/7, 365, that's nuclear
Mm.
power is always there, baseload power. It's the kind of thing you use for hospitals and airports and data
Hmm.
centers. The kind of thing that you don't want to switch off at night or ever.
I
And
understand. And to my earlier question about whether or not investors should be looking at domestic U.S. based nuclear or uranium producing companies, this next point says one of the big takeaways from the executive orders is that President Trump wants to maximize domestic production of nuclear fuel. He wants to also, according to the executive orders, increase the number of American workers at nuclear sites and uranium power plant, uranium mines. I wonder what incentive or incentives he's giving to to make uranium producers actually start producing in the U.S. and to actually bolster the production profile domestically.
yeah, I have to make uranium great again. I have to push back on that a little bit. This is fuel production, and those people, the workforce he's talking about is for, when you take the mine product and you vaporize it and you centrifuge it and all these things they do to the process to get
Oh,
to
I
the
see.
fuel pellet. The mines don't make the pellets. These 2 points that you're talking about are the work needed to take the mine product and turn it into the fuel, the actual fuel that goes into the reactor. So actually, that doesn't really
So the
incent production.
enrichment part.
If you didn't care where that uranium came from, you could do all these things and it wouldn't make any difference to the mines at all. So,
Okay.
but at the same time, the U.S. has established, and this was a Trump 1.0 idea, the U.S. has established a uranium reserve. And there's also clearly this drive towards, domestic sources of critical minerals. And uranium was cited a couple months ago in one of the earlier critical minerals executive orders. Uranium, and by the way, gold too, oddly enough, in the same one. But to this point, uranium was cited as one of these critical minerals that we need to incent to be produced more at home. So I'm not saying that the miners are not getting incentives in the United States. I think that's real. I think it's material, and I think it's investable. But those points that you showed, those are about the enrichment, which is a different. It's related, but a different question.
Well, that's still part of, yeah, that's a good point. And that should, in theory, bolster national security. We don't have to rely on, well, by we, I mean, the U.S. doesn't have to rely on other countries for enrichment, which is a key part of the process.
Especially since so much of that comes from Russia. Like,
Yeah. Yeah.
little incentive there.
How long will this process take, by the way?
Years.
Years? Okay. So we're looking at post Trump. They could still have. So in theory, this could be reversed, right? The
It
next
could,
administration.
but it's interesting, the U.S. uranium strategic uranium reserve, whatever the hell they call it, that was a Trump 1.0 idea, but it was under Biden that it got funded and the first purchases were made.
Mm.
And even, if you recall, it's not that long ago, under the Biden administration, there was, I think it was like 2.6 billion was allocated for encouraging the development of advanced nuclear. So the fact that uranium has finally become under the green umbrella, it's non-carbon emitting and so on. I think that actually makes it something that can endure changes of power.
Well, I'll finish off on this note. People should go to the Independent Speculator.com to learn more about Lobo's works, get his stock picks. What do you want people to know about the Independent Speculator? What can we learn from this site? What are you working on right now? Give us a teaser.
Lots of things there. I think the main takeaway is in the name. The Independent Speculator, I don't promise that I'm always going to pick the highest gaining stocks or that I know everything, that I'm always right. I do promise that I'm independent. There is no amount of money a company can pay me to say, this company is a great speculation when it's not, or I think the opposite. So, it a person who asks you to trust him is usually not trustworthy. So I'm not going to say trust me. Um, but if you come to agree, if you do your analysis and you decide that I really am an independent speculator, then
Yes.
I really think that's something that you should consider in your own input going forward.
Great. Thank you. We'll put the link down below, and we'll make sure to give Lobo a follow there. Thank you very much, Lobo, for your time today. I appreciate it. I know you're traveling in Europe, so we'll speak again soon. Take care.
Thank you, David. Good questions.
Thank you for watching. Don't forget to like and subscribe.